Hi everybody. In the previous video, we wrote adjusting journal entries to adjust the balance in prepaid expenses and unearned revenue. We also wrote adjusting journal entries to accrue revenue that had been earned but not yet recorded, and to accrue expenses that had been incurred but not yet recorded. In this video, we'll discuss depreciation, calculate periodic depreciation expense, and write an adjusting journal entry to record depreciation expense. Depreciation is used for plant and equipment, but never for land. Land is never depreciated. According to the matching principle, expenses should be recorded in the same time period that revenues earned as a result of those expenses are recorded. Thus, the long-lived assets must be depreciated in future time periods when they will be used to earn revenue for the company. Instead of adjusting the asset account directly, for example, the building account, we must use a contra-asset account called accumulated depreciation. This account maintains a credit balance, which is somewhat unusual for an asset account, and is directly related to the long-term asset that is being depreciated. While there are several methods to calculate depreciation expense, for Chapter 3 we will use only the straight-line method. The formula for calculating straight-line depreciation is cost minus salvage value divided by life. Salvage value is management's estimate of the amount for which the asset could be sold at the end of its life, sometime in the future. If a problem is silent about salvage value, you may assume that salvage value is zero. Let's work some examples. On January 1st, we purchased equipment for $240,000 cash. The equipment has a useful life of 10 years, which would be 120 months. There are 12 months in each year. 10 times 12 is 120 months in a 10-year period. What is the necessary journal entry to record the purchase of this equipment? Remember, this is a routine journal entry, not an adjusting journal entry. Please pause your video and write the journal entry, then start your video again to check your work. The journal entry necessary on January 1st to record the purchase of the equipment for cash is a debit to equipment, which is an asset account, for $240,000, and a credit to cash for $240,000. We make adjusting journal entries monthly, and we are now at January 31st. What is the adjusting journal entry necessary at this point? Let's do some calculations first. Remember that the formula to calculate straight-line depreciation is cost minus salvage value divided by life. And I had told you that if the problem is silent with respect to salvage value, you may assume that salvage value is zero. So cost minus salvage value divided by life in this problem equals $240,000 cost minus zero salvage value divided by 120 months. And that equals $2,000 of depreciation expense per month. So let's write the journal entry necessary to record the depreciation expense on this equipment for the month of January. The adjusting journal entry necessary at January 31st to record depreciation expense on this equipment for the month of January is a debit to depreciation expense dash equipment, $2,000, and a credit to accumulated depreciation - equipment $2,000. Now I know that some people say, well, we're making an expense for equipment, why don't we call it equipment expense? And what I have to say about that is simply that it's just not the way it's done. When you are calculating depreciation on long-lived assets, the proper expense account to debit is depreciation expense, and in this book it teaches us that you use an account, depreciation expense, associated with the piece of asset that you are depreciating. So in this case, depreciation expense - equipment. Now how about this silly accumulated depreciation - equipment account? Well, accumulated depreciation - equipment is an asset account. It has a normal credit balance. Instead of crediting the account called equipment, we leave that account alone completely. And we credit another asset account with a normal credit balance called accumulated depreciation - equipment. If it was a vehicle, we would credit accumulated depreciation - vehicles. This is a contra asset account. It attaches itself to this account that has a debit balance. Equipment has a debit balance. Accumulated depreciation has a credit balance. On the balance sheet, in the financial statements, the accumulated depreciation is subtracted from the equipment account to get a net book value of the equipment. In this case, it would be $240,000 minus $2,000, or $238,000 net book value for the equipment. Well, that's all for this video. In the next video, we'll calculate periodic interest expense on a note payable and accrue interest expense in an adjusting journal entry. See you next time.